Markets don't collapse in a day. They fracture quietly until one price exposes everything. For years, the world was told a simple story. Silver is abundant. Silver is boring. Silver is under control. Analysts called it an industrial metal. Bankers called it a hedge at best. Media dismissed it as a relic. And yet, against every expectation, every model, every official narrative, it happened. Silver traded at $71 in Shanghai. Not as a headline gimmick, not as a speculative flash, but as a real physical price. The price buyers had to pay to actually get metal. And the most important detail? Western banks didn't cheer. They didn't congratulate the market. They didn't call it a healthy rally. They panicked. Because this price was never supposed to appear. Not here, not now, not ever. To understand why this moment matters, you need to forget everything you've been told about silver pricing, because the number you see on your screen has not represented reality for a very long time. And Shanghai just proved it. The price that shouldn't exist. When most people hear silver price, they imagine a global unified number, one honest reflection of supply and demand. But that's an illusion. The price you usually see comes from paper markets, not physical ones. Futures contracts, derivatives, promises to deliver silver at a later date, silver that often doesn't even exist yet. For decades, this system worked because it relied on one fragile assumption. Most people would never ask for the metal. They would trade contracts, roll positions, cash settle, move on. As long as physical delivery stayed rare, the system remained stable. But Shanghai broke that assumption. Because in Shanghai, silver isn't just traded, it's taken. And when enough buyers demanded physical silver at the same time, the price didn't gently rise, it snapped. $71 wasn't enthusiasm, it was scarcity revealing itself. Why this is not just another rally. Every bull market has skeptics. This is temporary. It's a premium issue. Arbitrage will fix it, but those explanations fail one simple test. If this were temporary, if this were noise, if this were speculation, then Western banks would be calm, but they aren't, because they understand something the public doesn't. Once physical price discovery escapes paper control, it doesn't politely return. The silver market isn't breaking because demand exploded overnight. It's breaking because years of artificial suppression finally collided with physical reality. And that collision didn't happen in New York. It happened in Shanghai. The silence is the signal. Notice something strange. This should be front page news. A key industrial metal, essential for solar panels, electronics, medical equipment, defense systems, suddenly trades at a massive premium in the world's largest manufacturing economy. That should spark headlines. Instead, silence. No emergency panels, no urgent warnings, no deep explanations. Because explaining this requires admitting something dangerous, that Western pricing systems no longer control global reality. And once that truth is spoken out loud, confidence becomes very hard to rebuild. A crack, not a crash. This is not the collapse, not yet. This is the crack. The moment where two prices appear, one for paper, one for reality. History tells us what happens next, but never immediately. First comes denial, then explanations, then policy responses, then failures disguised as fixes. And only later does the public realize that the shift already happened. Right now, most people still believe silver is behaving normally, but markets don't change when everyone notices. They change when almost no one does. The question that terrifies banks. There is one question. Western banks cannot answer publicly. What happens if physical buyers stop accepting paper prices altogether? Because if that happens, contracts don't just lose value, they lose meaning. And $71 silver in Shanghai suggests that moment may already be closer than anyone wants to admit. But this didn't start today. It didn't start this year. And it certainly didn't start in China by accident. To understand how we got here and why this outcome was inevitable, we have to go back to the system that was designed to prevent silver from ever doing this. That system was built decades ago, and it worked until it didn't. The system built to control silver. How price discovery was taken away. Every controlled market begins the same way, not with force, but with convenience. To understand why $71 silver in Shanghai triggered panic instead of celebration, we need to rewind. Not years, but decades. Because what you're seeing today is not a sudden event. It's the failure of a system that was engineered to never let this happen. And that system wasn't built in China, it was built in the West. When silver was money, and why that ended for most of human history, silver didn't have a price. It was the price. From Roman trade routes to Islamic dinars to Chinese taels and seises, silver settled debts because it couldn't be faked, printed, or multiplied. That made it powerful, and that power eventually became unacceptable. By the early 20th century, governments discovered a hard truth. You cannot run expanding debt systems on hard money. Wars, welfare states, financial bailouts, none of them work if money has limits. So silver had to be removed from its monetary role, but doing it openly would cause revolt. So instead, it was done quietly. The first step: demonetization without confiscation. Gold was attacked directly. Silver was neutralized differently. Instead of confiscation, policymakers used legal reclassification, industrial framing, gradual withdrawal from coinage. By the mid-20th century, silver coins disappeared, silver certificates vanished, public memory faded. Silver was no longer money, it was now just a commodity. But that was only step one, because as long as silver traded freely in physical markets, it could still expose monetary excess. So a second step was required: the paper solution. The solution was elegant and dangerous. Create paper silver, futures contracts, options, unallocated accounts, ETFs backed by claims. Instead of trading silver itself, the world would trade promises of silver. This did two things immediately. It multiplied apparent supply. It centralized price discovery. Now, instead of price being set by buyers and sellers of metal, it was set by banks, exchanges, market makers, clearinghouses. The most important of these? COMEX. How COMEX changed everything. COMEX didn't need to control silver physically. It only needed to control expectations. Here's how it worked. For every ounce of real silver in a vault, dozens, sometimes hundreds, of paper claims were issued. That leverage created an illusion of abundance, and as long as contracts were rolled forward, cash-settled close before delivery, the system stayed intact. Very few people noticed something critical. COMEX prices were not prices of silver, they were prices of leverage, and leverage is only stable when trust remains. Why suppression wasn't a conspiracy, it was a requirement. This wasn't about evil intent, it was about necessity. Silver competes with fiat currency. When silver rises sharply, inflation expectations rise. Currency credibility weakens bond markets, destabilize, so volatility had to be managed, not eliminated, just contained. Banks used massive short positions. Algorithmic selling liquidity shocks during thin trading hours, not to destroy silver, but to keep it boring. And for decades, it worked, until one thing changed. The fatal assumption. The entire system depended on one fragile belief: physical demand will never overwhelm paper supply. As long as industrial users could source metal, as long as investors accepted ETFs, as long as delivery remained optional, everything stayed balanced. But that assumption ignored one reality. Paper claims don't power factories. Metal does. And as global electrification, solar expansion, defense tech, and electronics demand surged, silver wasn't just a hedge anymore. It became critical infrastructure. And critical infrastructure cannot be papered over forever. Enter China, with a different philosophy. China studied Western markets carefully, and it noticed something important. The West priced silver as a financial asset. China treated silver as a strategic material. Instead of encouraging leverage, China emphasized physical settlement, inventory transparency, domestic supply security. The Shanghai Futures Exchange and Shanghai Gold Exchange were built with one key difference: delivery mattered. If you bought silver, you were expected to take it. That single difference changed everything, because it meant paper promises had consequences. Two systems, one metal. By the time the world noticed, it was already too late. Two silver markets had formed. The Western paper market, high leverage, low delivery, stable prices. The Eastern physical market, tight supply, rising premiums. Real demand for years, arbitrage kept them loosely connected. But arbitrage only works when metal flows freely. And metal was quietly disappearing. The seeds of the break mine supply stagnated. Ore grades fell, new discoveries slowed. Meanwhile, ETFs absorbed metal governments stockpiled quietly. Industrial demand accelerated every year. A little more silver left the open market. Every year, paper claims increased. This imbalance didn't explode immediately. It matured, like pressure building beneath the surface. And eventually, the question became unavoidable. What happens when physical buyers stop caring about paper prices? That question would be answered, not in New York, but in Shanghai. This isn't a story of sudden chaos. It's a story of structural inevitability. A system built on leverage, meeting a world that suddenly needed metal. And when that collision finally happened, the price didn't adjust gradually. It jumped violently, because reality always reprices faster than models expect. How Shanghai broke free. Markets don't warn you when control is slipping. They whisper, then they stop listening. By the time silver printed $71 in Shanghai, the break had already happened. What the world saw was not the beginning. It was the confirmation. Because long before the headline, the silver market was already behaving in ways that no paper-based system can survive. And it started with something almost invisible: premiums. The first signal. No one took seriously. At first, it looked harmless. Physical silver in Asia began trading slightly above Western paper prices. $1 here, $2 there. Analysts called it regional demand differences, logistics issues, temporary refinery bottlenecks. But something about these premiums was different. They didn't fade. They didn't normalize. They persisted. Every time COMEX prices dipped, Shanghai premiums widened. That was the first sign that price discovery had split in two. Because in a healthy market, lower prices attract supply. In this market, lower prices repelled it. Why metal stopped flowing? West arbitrage is supposed to fix everything. Buy low in New York, ship to Shanghai, sell high. But arbitrage only works if metal is actually available. And slowly and then suddenly, it wasn't. Vault inventories that looked adequate on paper were already committed. To ETFs, to industrial contracts, to long-term offtake agreements. The same bars were counted multiple times. So when traders tried to source real metal to exploit the price gap, they hit a wall. Delivery delays, minimum quantities raised, cash settlement encouraged. These weren't random inconveniences. They were soft refusals. And soft refusals are how shortages begin. Industrial demand changed the game. Silver demand didn't rise because of speculation. It rose because the world changed. Solar panels, electric vehicles, 5G infrastructure, medical technology, defense electronics. Silver became non-optional. Factories don't hedge with futures. They need metal. And when Chinese manufacturers began locking in supply directly, bypassing Western intermediaries, the paper market lost its most important buffer. Because industrial users don't roll contracts. They take delivery. Shanghai's rules made the difference. Shanghai didn't tolerate the Western illusion. If you bought silver on the exchange, you were expected to. Take it, store it, use it. No endless rolling, no infinite leverage, which meant every contract created real pressure on supply. As more buyers demanded delivery, prices had only one place to go: up, but not smoothly, violently. The moment arbitrage failed, this was the turning point. For years, the gap between paper and physical prices was managed through metal flows. Then one day, the metal didn't arrive. Traders who expected delivery received offers to settle in cash instead, at a discount. That's when the market understood something crucial. The paper price was no longer the clearing price. The real price was whatever it took to get silver now, and that price was rising fast. The $71 print, what it really meant. When silver finally hit $71 in Shanghai, it wasn't a spike, it was a declaration. It said, supply is tighter than reported paper claims, exceed reality. Physical buyers set the price now. Western analysts tried to frame it as a regional anomaly, a speculative blow-off, a temporary distortion. But distortions don't last this long, and they don't survive rising volume. Why this price terrified banks? Banks don't fear high prices, they fear loss of control, because once buyers accept a higher physical price, something irreversible happens. They stop referencing paper benchmarks, contracts are rewritten, suppliers renegotiate, hedges break, and the entire derivative stack becomes unstable. $71 wasn't scary because it was high. It was scary because it was independent. The silent response. Notice what didn't happen. No coordinated selling, no massive intervention, no emergency transparency, because intervention requires metal, and metal was already spoken for. So instead, the response was quiet. Risk limits tightened. Delivery rules adjusted. Messaging softened. The goal wasn't to reverse the move, it was to contain the narrative. The shift was already complete. By the time Western markets reacted, the damage was done. The silver market had entered a new phase. Two prices, two realities, one metal. And history tells us how that ends. The paper price eventually chases the physical one. Always. But never without volatility. This wasn't a conspiracy. It wasn't manipulation gone wrong. It was physics. Finite supply meets non-negotiable demand. And Shanghai simply allowed that truth to surface, but the story doesn't end with the rise. Because every break triggers a response. And the response that followed this one would expose just how fragile the Western system really was. Western banks in panic. Panic in finance rarely looks like chaos. It looks like closed doors and rewritten rules. When silver crossed $71 in Shanghai, the problem was no longer theoretical. It was operational. Because for the first time in decades, Western institutions were forced to confront a reality they had designed their systems to avoid. What if the silver simply isn't there? Not eventually, not someday, But right now, and that question has consequences that no press release can neutralize. The moment delivery became the threat, paper markets can survive almost anything. Volatility, headlines, even public skepticism. What they cannot survive is mass delivery demand. As Shanghai prices surged, something subtle but dangerous happened in the West. Longholders stopped rolling contracts. They asked for metal. At first, it was manageable, then it wasn't. Delivery queues lengthened, lead times stretched, minimum withdrawal sizes increased. None of these were labeled shortages. They were called procedural adjustments. But in commodity markets, those phrases mean one thing: stress. Vault inventories, full on paper, empty in practice. Official reports still showed silver in vaults, plenty of it. But ownership mattered. Much of that metal was already pledged, already leased, already promised elsewhere. The same bar supported an ETF share, a futures contract, a lease agreement. As long as nobody asked at the same time, it worked. But Shanghai changed timing. Now everyone wanted silver now, and timing is everything. The lease rate, spike. No one explained. One of the clearest signs of panic didn't show up in headlines. It showed up in lease rates. When silver lease rates jump, it means holders are demanding compensation to part with metal, even temporarily. That only happens when supply is tight, counterparty risk is rising, trust is weakening. Lease rates don't spike because of speculation. They spike because someone needs metal urgently. Cash settlement, the unofficial admission. When delivery gets dangerous, the system reaches for its safety valve. Cash settlement. Instead of silver, longs are offered money, sometimes more, sometimes less, sometimes quietly encouraged. Cash settlement isn't failure, but when it becomes preferred, it's a confession. It says, we can honor the contract, just not in silver. And that changes everything. Because once market participants believe delivery is optional, confidence fractures. And paper markets run on confidence. Why no one rang the alarm. You might wonder why this didn't explode into public view. Why no emergency announcements? Why no televised explanations? Because panic doesn't help a leveraged system. Silence does. Behind closed doors, risk desks tightened exposure. Position limits were reassessed. Delivery rules were clarified. Not to solve the problem, but to buy time. The failed fixes. Authorities tried familiar tools. Liquidity injections, expanded paper supply, verbal reassurance. But none of those create silver. You can print contracts. You can't print atoms. Each attempt to calm the market exposed the same weakness. The problem wasn't price. It was availability. And availability doesn't respond to policy. The unthinkable became discussable. Once Shanghai proved a higher physical price was possible, a dangerous idea entered the room. What if Western benchmarks are wrong? Not temporarily, not slightly, but structurally. If that question spreads, the entire pricing hierarchy collapses. Because benchmarks don't just price silver. They price supply contracts, industrial planning, risk models, national reserves. This is why banks panicked, not because silver was expensive, but because it was telling the truth. The quiet retreat. Instead of fighting Shanghai directly, something else happened. Western markets began to follow. Not publicly, not officially, but gradually. Spreads widened. Premiums rose, delivery terms tightened. The paper price started chasing reality. Slowly, painfully. What Part 4 reveals. This was the breaking point. The moment where containment failed and management replaced control. The illusion didn't shatter, it eroded. And erosion is worse because it's harder to stop. The silver market didn't collapse, it transitioned. From belief to negotiation to reality. But the story doesn't end with panic because every systemic break leaves behind consequences. For currencies, for commodities, for trust itself. What $71 silver really means for the future. When a market tells the truth, it doesn't ask permission, it forces a reckoning. By the time silver printed $71 in Shanghai, the argument was already over, not publicly, not officially, but structurally. Because no financial system survives the moment when its reference price is no longer believed by the people who actually need the commodity. And silver had crossed that line. The pattern. History always repeats this isn't the first time a paper pricing system lost control of a physical metal. In 1968, the London gold pool collapsed when central banks could no longer suppress gold prices with paper sales. In 1971, Bretton Woods ended when the U.S. could no longer deliver gold at the promised price. In 2020, gold futures faced delivery stress as physical demand overwhelmed paper settlement. Every time, the sequence was the same. Paper prices diverge from physical reality. Authorities deny the significance. Delivery pressure exposes the truth. The system resets. At a higher price, silver is now following that script. not because of conspiracy, but because physics always wins. Why silver is more dangerous than gold. Gold threatens confidence. Silver threatens functionality. Silver is embedded in solar panels, semiconductors, electric vehicles, medical equipment, military systems. You can delay gold delivery. You cannot delay factory output. That's why silver breaks systems faster. And once industrial buyers accept a new clearing price, it becomes the reference, whether banks approve or not. The failed fixes don't fail quietly. Authorities will attempt more solutions. They always do. Expanded paper contracts, adjusted margin rules, new benchmark methodologies. But these are not fixes. They are translations of scarcity into policy language. None of them create metal. And every failed fix accelerates the shift away from paper trust. The modern parallel. No one wants to name this isn't just about silver. It's about the global monetary system. For decades, the world accepted dollar settlement. Western benchmarks financialized commodities because they worked until they didn't. Shanghai didn't break the system. It revealed that it already was. 3 clear takeaways. 1. Physical markets have reclaimed price discovery. When delivery matters, leverage becomes irrelevant. 2. Western banks didn't lose control suddenly. They lost it gradually, then all at once. 3. This shift doesn't stop with silver, gold. Energy and strategic materials are watching closely. The warning systems built on confidence do not collapse loudly. They erode quietly until trust moves elsewhere. Silver didn't just hit $71, it crossed a line. And once crossed, history shows it's never uncrossed. The open question. If physical reality now sets the price, what else has been mispriced for years? If you want to understand the difference between paper and physical markets, why Shanghai matters more than headlines, now history signals what comes next. Subscribe, share, and stay engaged. Because moments like this don't repeat often. And when they do, those who understand them early are never confused by what follows.